Supply and demand, the dynamics between the two are at the heart of any trade, and the same is true of the share market. The push and pull between the two also reflect the price of a security, its availability, and the desire to own such a security. In the share market, technical analysis is used to examine or foresee movement of prices. One of the important aspects of such an analysis is determining supply and demand, S&D, zones. What does trading supply and demand zones imply? Supply and demand zones are at the heart of supply and demand trading. These zones are areas that show liquidity at a specific price. The supply zone is also called the distribution zone, while the demand zone is called the accumulation zone. Importance of supply and demand zones. Points to consider: supply and demand zones are responsible for driving the markets. Trading supply and demand zones helps investors make any purchase or sale decisions. When the price of a stock stops falling beyond a specific level and begins to move sideways for a stretch of time, this means that the stock is seeing accumulation and could move up. The distribution zone is the point at which price drop begins and starts its downward movement. To simplify accumulation, a stock that's bullish is indicative of high demand and is seeing accumulation. Similarly, a stock that's bearish shows greater supply than demand and is showing distribution. Distribution indicates selling side pressure, whereas accumulation is indicative of buying pressure. The law of supply and demand governs all market prices. Supply and demand zones put the economic theory into a trading strategy using price charts. Read on to learn more about S&D trading. Contents: supply and demand zones. What are supply and demand zones? Wyckoff and market structure. Types of supply and demand patterns. How to draw a supply demand zone. Identifying strong supply and demand zones. Supply and demand zone indicators. An example: SD zone trading strategy. What are supply and demand zones? Supply and demand zones are a popular analysis technique used in day trading. The zones are the periods of sideways price action that come before explosive price moves, and are typically marked out using a rectangle tool in the stocks, forex or CFD trading platform. A supply zone forms before a downtrend. Structure of market price goes through the following phases: accumulation, reaccumulation, uptrend, distribution, redistribution, downtrend. Supply and demand laws control all marketplaces. When discussing trading in the market, most traders depend on technical indicators to identify imbalances. However, others watch supply-demand trends and zones to formulate a trading strategy governed by economic theory. Banks and other similar institutions create these zones, which are actually price levels where unfulfilled orders wait to be completed. To win over the whole concept of supply and demand, traders need to find smart money orders on the price chart. Moreover, they also need to identify the supply-demand zone correctly. In this article, you will learn step by step what supply and demand zones are and how you can identify them on the price chart. Demand and supply vis-a-vis support and resistance. Areas of supply-demand leads to support and resistance, S&R, creation. Support and resistance levels are widely used by traders to make decisions. Resistance is the price level on the chart at which an asset's price increase hits pause. Support is the level on the chart when the downward trend hits pause. Supply and demand zones are spread across a wider area than support and resistance levels. The broader coverage ensures that you can assess price movement in the future more reliably than a single level or line in the case of S&R. An understanding of both S&R and supply and demand can help when it comes to analyzing price charts. Any talk of supply and demand trading invariably includes finding supply and demand zones using candlestick charts. Spotting big candles forming in succession on the chart, and establishing the base will help you draw the S&D zones. 3 things to consider for supply and demand trading. 1. The first thing is to identify if you are in a supply zone or a demand one. In the supply zone, the prices are higher than the bid price, and in the demand zone, they are lower. The bid price is what a trader is willing to pay for a stock. 2. The next thing while trading supply and demand zones is to identify the pattern. If you see whether the trend reverses or continues, you can ascertain whether you want to buy or sell, depending on the most active zone. 3. The third